All right, it's 5:31 Mountain Time, so we will go ahead and get started with this evening's presentation. I want to thank you all for taking some time out of your evening to join us for this September rendition of the CattleFax Trends Plus cow-calf webinar series. We really appreciate you all taking your time. It's raining here in Denver this evening, and so we sure hope that you all have caught some wherever you're at or are able to here in short order. So with that, to start off this evening, first of all, we need to start by thanking Elanco for their continued sponsorship of this program. They have sponsored this for quite a few years at this point, and we thank them for doing that and making this webinar series available and free to anyone. And so as we start going into this evening's discussion, just a quick preview as far as what to expect. First and foremost, we're going to start off with the feed, grain, and hay situation update. We know with these costs that's first and foremost on many folks' minds, so we'll spend a good deal of time there. Then move on to the cattle side, look at the supply and demand expectations, and then get a little bit more specific into the outlook for the fall and winter calf and yearling markets. And then finally, we'll hear from Dr. Ayers of Elanco Animal Health. So to take us through the first portion of the discussion, I'll pass this over to Troy Bockelman. Troy?
All right. Well, I appreciate everyone joining us today. And, as we think about this corn market and even the hay market, whether you're talking about soybeans or wheat, there have been pretty stout prices over the last 18 months. And the question is, are the stout prices going to continue, or are we going to see some relief? Coming into the summertime period, the forecast did call for more of a hot and dry summer, much like a year ago. A year ago, yield was about 177 bushels per acre. It was record high, about 0.6 above the previous record. We had the exact same precipitation in July relative to a year ago at 3.6 inches on a corn harvest weighted average, but the heat was just so much more dramatic that it affected the corn yield, especially as you got into the western corn belt. So the USDA came out this week on Monday and reduced corn yield another 2.9 bushels to 172.5. At the same time, they reduced acres by 1.2 million acres for planted acres. That's almost a 5 million decrease in acres compared to last year. And so you have to start looking at the balance sheet and saying, okay, what's going on with this balance sheet and what's this going to mean to the market? They did change demand 250 million bushels, but stocks to use tightened from 9.6% and to 8.5%, almost a 2% decrease from the prior year. So as we look at that, the first thing we'll talk about is yield. Yield has been below trend now. This will be the fourth year. Trendline yield was about 180.5 bushels per acre. So you're essentially talking about almost an 8 bushel below trend yield that is occurring this year. Now, the September WASDE, the USDA estimated that yield, but that's not the final word. When you look at corn yield, the change in corn yield from September to that final yield number, it's about a flip of the coin, historically speaking, of whether the yield gets bigger or the yield gets smaller. But this chart doesn't tell the whole story because the old farmer's adage is, right, big crops get bigger, small crops get smaller. And so you start looking at some probabilities. When you look at when yield is lowered in September, it's lowered again in October in 10 of the last 15 times they did it. So there's about a 66% probability that the 172 yield won't hold, and it'll actually be smaller than that. So when you look at the overall corn picture, there's risk that stocks to use could even tighten a little bit. And so you go through the balance sheet, supply and demand. The first thing you look at is corn production. Corn production is estimated to be down about 1 billion bushels from a year ago. So that's a pretty significant change in that total supply picture. Now, if we see yield move a little smaller, we're not suggesting that yield could go to 168 or something like that, but could it go down to 160 or 171 and a half, 172? Yeah, the data says that's possible. So as you look at this bigger picture, production likely won't get bigger from here in this current marketing year. You remember in cattle, we harvest cattle every week, but in corn, we only plant one crop a year. This is the crop that's going to have to carry us all the way through the winter, through next summer, and into the 2023 harvest. So we're already starting with smaller production. You look at this chart, it's the smallest production since 2019, but it's well below the years we've had here going back to really 2013 was the last time we had a crop that was that 13 and a half and above. We're on the lower end of the range from the last 10 years. So it comes back to usage. We know the supply side, it could change a little bit, but significant decrease in the supplies. The top chart here, that's looking at corn feed and residual usage. The USDA lowered feed and residual usage about 100 million bushels from August into September, but that's about a 350 million bushel decrease from the year prior. Now look at the grain consuming animal units. The grain consuming animal units are about flat. Yeah, they're down from the 2019 2020 highs, but the USDA is suggesting that we're going to use 350 million bushels less corn with a grain consuming animal unit that's about flat. So it all comes back to that residual. That residual is the error in the balance sheet. If the USDA feels that corn got found or got lost, they put it in that residual if they can't account for it someplace else. So there is some room there. But we would argue that they probably can't take much more out of it. You look at the wheat crop, the winter wheat crop that's going in, getting planted now, prospects aren't very good to build those wheat supplies. You look at the cattle on feed on September 1st, it's going to be right close to year ago levels, maybe 1% lower. So there's still a lot of animals out there to feed. And the USDA is suggesting that feed and residual use is going to move lower. Well, how much lower could it go? Probably not significantly lower. Then you look at ethanol, corn use for ethanol. They left it flat with a year ago. They had it up 50 million bushels. You really can't argue that too much. You look at the inflation, the price of fuel, the miles driven, people working from home, all the other stuff that's going on. You could make the argument that ethanol usage is going to be a little flat. We're not seeing a big increase in miles driven over the next year. Probably not a lot of workers going back to the office. If they've already gone back to the office, they already have. So relatively flat, especially with higher corn prices, would ration some of that usage in the ethanol. The next category, exports. They lowered exports by 100 million bushels. So we're talking about exports now about 2.7 up here. Now we're talking about 2.25 or 2.3, 400 million bushel decrease in exports over the last 2 years. Look at Brazil's corn production. This first red bar, so the 2021-2022 market year, that's the crop that just got harvested. They're going to start planting here next month, the 2022-2023 crop. There was a lot of concern over the last year about the La Nina weather pattern. La Nina means dry South America, dry southwest of the U.S., would have an impact on their corn crop. Well, the USDA is suggesting, and whether you look at CONAB in Brazil, that they're going to have a record corn crop. So the drought that we experienced in the southwest of the U.S. wasn't nearly as bad as it was suggested to be prior to their planting season in Brazil. They produced a crop. They're increasing acres as well. So our export number down closer to that 2.2 to 2.3 billion makes a little sense. There's more corn to be exported from Brazil. You look at the bottom chart, you have the 2021 marketing year right around 3.4 billion bushels. Now we're talking closer to 4.4 billion bushels. There's another billion bushels coming from Brazil. Higher prices in Brazil, higher prices in the U.S., lower prices in the Brazil. It'd probably take some market share away from U.S. exports. So you can't argue with the balance sheet relative to that either. So can they take more out? Can they take more out if yield moves smaller? Likely can't take significantly more out of the feed and residual category, but you could take a little bit more out of exports and you could take a little bit more out of ethanol, and it may be justified. So it comes back soybeans. This is another market we need to pay attention to. Soybeans lost 500,000 acres. But look at this, the year-over-year change was about 300,000 acres above year ago. Remember corn? Corn year ago, almost 5 million acres more than we had today. So we planted in total less acres. Yield also moved lower to 50.5 bushels per acre, down 1.4 bushels from the August WASDE report, and about almost a full bushel below year-ago levels. They made a slight demand change, but we're still talking about near record crush, or record crush in this case, ending stocks at 200 million bushels. So if we start seeing soybean yield move lower, when you have a 200 million bushel ending stocks change and you change it by 20 million bushels, that's a bigger change than a 50 million bushels on a 1.1 billion bushel ending stocks on corn. Small changes in the soybean balance sheet can have a larger impact on stocks to use for soybeans. So you look at this total principal crops. This is what we need to pay attention to going into next year. This acres battle. You have stocks to use for corn that have tightened almost 2% from a year ago. You have stocks to use for soybeans that have tightened almost 1% from a year ago. Total principal crop acres are down 2.1 million acres. If you were a farmer and you were looking at planting corn or soybeans this in 2022, economics, even with higher fertilizer prices, the higher prices allowed you to lock in a margin, and you should have been planting fence row to fence row. But we're losing total principal crop acres. Total corn and soybean acres were down 4.49 million acres from a year ago. We planted a little bit more cotton, up 2.6 million acres, but I think the bottom line is we don't have any more acres out there to plant. Whether it be urban sprawl, the city's getting bigger. We live here in Denver, and it seems like Denver just keeps getting about a mile further out of town about every year. I come from Minnesota. Urban sprawl in the Twin Cities, taking away some of that farmland, but conservation efforts as well, whether you're talking about ducks unlimited or pheasants forever. Minnesota has a program that they're putting some farmland back into wetlands or grass. They're paying farmers to increase the green belts around the rivers and the drainage ditches. Things like that are all slowly taking acres away. So it comes back to the price expectations going into next year. And you look at December corn futures. We put in a high. We'll round it off at 750 in May. We came back down and we tested that 560 area. We're now back up to that 682, 683 area. And we're sitting here saying, okay, based upon the chart today, what's the expectation for the market going forward? And what's the market expectations for fundamentals today? So we've tested that 618 retracement level. We're back to where those moving averages crossed. The market is at a decision point. It needs to decide, do we need to go ration some more usage because supplies are getting tighter, or are we fundamentally correct in our prices today? Well, we would argue, fundamentally speaking, at 8.5% stocks to use, we're likely pricing in the fundamental expectations. Based upon this scatter plot, and we're adjusting these numbers for inflation expectations in the fourth quarter. I'm going to give you a little optimistic tone here. We have this inflation for the fourth quarter of 2022 up 6% from last year. So we have all the previous prices adjusted to the real price in 2022 dollars. It suggests that at 8.5% stocks to use, you should average somewhere around 675. We're right around today at 682. So we're in line with the fundamental expectations. but we need to pay attention to this acres battle because neither corn or soybeans can afford to lose acres going into next year. They're going to compete against each other. Now, weather patterns change. We move from a La Nina more to a neutral pattern. Do we start to see more potential for yield next year? But without the acres, they're going to battle each other for acres. That's going to be supportive to prices. And then we're going to have a strong yield to build corn supplies. Just think, a couple years ago, the USDA was printing a 22.5% stocks to use. That's now down to 8.5% stocks to use, and it's gotten smaller since a year ago. So the market will need to protect those acres. So as we look at that, fundamentally speaking today, we're adequately priced. But there's risk into the spring of next year that we would see prices advance. How can the market ration demand? One way it can ration demand is just through the futures market. The other way it can ration demand is through basis. When you look at the Omaha spot cash corn price, you have basis up here at 40 cents premium today. Historically speaking, you should be down here closer to par. If you're in the South Plains of Texas, you're paying almost $9.25 for corn, if not maybe a little bit more. So the tighter supplies in the South, the basis is stronger in the South, and we're maintaining a premium in those southern markets, whether you're talking about Kansas or whether you're talking about Texas. So you have stronger basis in the Midwest with even stronger basis in the Southern Plains to try to draw that supply out of the Corn Belt region and into Texas, Oklahoma, and Kansas. The market is looking at rationing the corn usage through both the futures market and basis, but the futures market will have to protect those acres going into the spring. So as we look at this, what's our expectation for the corn market in the 2022-2023 marketing year? That marketing year started 14 days ago on September 1st. It's going to run almost 12 months to August 31st of next year. We think we will continue to have stout prices with an average futures price around $6.75. If we start to see tightening acres or tightening stocks to use for corn and soybeans, and that acre battle heats up pretty good, you could see spot corn futures prices going into the spring go back and test that $8 level. Looking at December corn futures or March corn futures today, you're talking about another $1.10 to $1.20 advance in the corn market. Then if we get a big yield, we could come back and test that 550 area as we get into kind of that August time period of next year. If everything goes right, likely find that closer to that 6 to 640 area because we'll have to wait to see what yield prospects are. But averaging higher, about 20 cents at 675 next year, with the price potential going into the spring to reach that $8 area. Now, if soybean stocks to use, if they don't get smaller and they actually get a little bigger, you could probably cut some of that top side off. Or if corn yield gets a little bigger, you could cut some of that top side off, but you need to recognize the risk of higher prices going into the spring. Now, you're looking at this chart saying, why are you telling me what happened on May 1st? That was how many months ago and we don't care? Well, the USDA only gives us a hay stocks report twice a year, on May 1st and on December 1st. On May 1st, hay stocks were down 7% from a year ago to 16.8 million tons. Lowest number it's been since 2019. You can see the trend moving lower on the last three lines. And you have to ask yourself, well, if the drought had this big of an impact on the corn market, what's it going to have to do with hay? Hay harvested acres were slightly higher on this top left chart. You can see we're slightly above 50. We went to slightly above 51, so we added about 1 million more hay acres. But look at your yield. Hay yield was the lowest point it's been since the 2012 drought. So hay production was tied with the 2012 drought. We are not building hay stocks this summer. we will continue to have tight hay supplies all the way through next spring until we start harvesting again in May or June. So you have higher feed grain prices supported through tighter stocks use and relatively strong demand, and you have lack of hay production continuing to support hay prices. So what do we look at relative to price? This is a monthly U.S. average all hay price. So this accounts for all hay in the U.S. You can see the sharp increase we had from June into July. We went from 210 all the way to 235. So we had a $15 move just from June to July because you started to see that we were not going to produce that crop. We're suggesting that hay prices in 2022 to 2023, so starting a few months ago, going into April of next year, are going to average $225 a ton on a U.S. average. Regionally, of course, there will be some differences, right? Especially in the western half of the U.S. If you get down into the Southwest, higher hay prices. They have had some rain up there in Washington, Oregon, Idaho. Maybe they have a little softer hay prices. Kansas, Nebraska, hay prices a little more stout. Further east you go, you may have a little relief in hay prices, but on average, expect higher hay prices by about $30 for a U.S. average. That's what I have for you today. Go ahead and pass that over to Patrick Linnell.
All right, thanks, Troy. So before we dive into the next section, I would like to remind everyone, if you do have any questions for myself, Troy, or Dr. Ayers, there is a question box there available to you. Go ahead and throw them in there, and then we'll save some time at the end to answer any questions. So as we do start to change the script a little bit and dive into the nuts and bolts of the cattle market outlook, you'll find that the bulk of our outlook really does center around this chart, and all comes back to beef cow slaughter. And clear since the beginning of the year, we have seen pretty substantial beef cow slaughter rates. And really that's on top of what was already fairly aggressive beef cow slaughter in 2021. And as it sits today, beef cow slaughter running up 13.5% year to date. And even if it does narrow that year over year gap that you're seeing between 2022 and 2021, there through the fourth quarter, where we were through the fourth quarter of last year is probably knocking on what non-fed packing capacity likely is. So somewhat limited there. But nonetheless, we're looking at beef cow slaughter that will finish the year up somewhere north of 10%. And what that translates to, on top of a year over year smaller beef cow herd, we had less cows coming into the year, would be a record beef cow culling pace. And so as you think about the slow moving ship, slow turning ship that is the U.S. cattle industry, in terms of just the long biological life cycle, this is going to have a lasting effect in terms of where the beef cow inventory is headed over the next few years. And you add on top of that, how many heifer calves last year were not retained or have already gone to town this summer, especially through parts of the Southern Plains, and may go to town again this year, head into a terminal route instead of the replacement pen. That's going to have a long tail. And so as we look at this 2023 forecast for the beef cow inventory, it is pretty well set in stone that we'll see over 500,000 head decline. Our current forecast is around a 2% decline in the beef cow inventory into January 1 of next year. But realistically, this implies several more years of beef cow herd contraction after that, looking at a low either in 2025 or possibly edging into 2026 by a smaller margin. And as you look back over your shoulder, a pretty eerie reflection, eerily similar to what we saw throughout the last drought cycle. Recognizing that it was drought and poor margins that caused the last beef cow herd liquidation. And we know that even pre-drought, pre the last 18 months to 2 years, we were already in a liquidation phase due to squeezed margins. So a lot of parallels as you look back over our shoulder to just the last drought cycle. Now, obviously, less cattle, less cows means that there will be smaller calf crops, smaller fed slaughter rates over the next few years as well, following that beef cow herd inventory by roughly 1 to 2 years. But as we look to the broader protein production landscape in the United States and take a step back, look at beef, pork, and poultry production. So we do know that beef production will likely see some declines over the next few years. And as we look at the other protein production sources here, and think about the outlook that Troy just laid out in terms of feed grains, pork and poultry much more responsive to either expanding or contracting, or at least flattening their industries based on feed grain prices. So we also see where pork and poultry production should be more flat over the next few years as well. At the same time, while beef is declining, simply on the numbers, as you think about number of head running through the system. So as you do think about where we've been in an era of honestly pretty cheap protein prices over the last few years, well, no surprise when you think about this pace of increase that we've been in since the middle of the last decade. And now as we head forward, we're no longer going to be seeing that increasing environment, looking at actually something that's steady to more likely declining. So specific to trade, so beef production will be decreasing, although it's still pretty significantly large here today. As far as where that beef goes, exports remain extremely strong this year, on pace to be up somewhere around 5% on top of what was already near record, or what was a record last year. At the same time, we do see where imports starting to edge up, the bulk of that already behind us in the first quarter of this year, as Brazil was locked out of China due to some geopolitical spats there and their atypical case of BSE. But nonetheless, as we do transition forward, we likely may see some more imports as you just think about more lean while we're harvesting less cows of our own. But nonetheless, the export side remains extremely positive. China accounting for the bulk of our export growth, while those more traditional Asian markets of South Korea and Japan remain extremely strong. And what's the most significant to us is what we'll deem the others category. Those smaller countries that individually we may not track all that closely, but collectively, they're the second largest growth category that we've seen. And so as you think about diversity of export markets and the safety factor that entails, certainly hugely positive as you think about that. And this is all on top of a dollar that's been moving pretty radically higher, making our exports more expensive. But at the same time, export buyers, those global buyers, are not slowing down. So as we look at the forecast for next year, again, beef production will be declining on what we have forecast to be a 900,000 to 800,000 head decline in fed slaughter. At the same time, that balance of trade also likely edging in our favor again next year, or at least stable. So as a result, the per capita net beef consumption, or net beef supply, what's available here to domestic consumers, will drop by somewhere to the tune of close to 2 pounds, our current forecast for a 2.7 pound decline next year in per capita net beef supplies. So what that means in terms of price, these markets, as you tighten up supply, price obviously responds higher. Tighter supplies on constant demand means stronger prices. Now, speaking of demand, that's obviously top of mind to a lot of folks. Yesterday's inflation number coming in up 8.3% was obviously a pretty big shock to the stock market, with the Dow decreasing, shedding around 1,100 points yesterday. And as you think about the impact of inflation and some of these recessionary challenges that we're facing here, not to discount those challenges at all, but as we do look at this supply decline and recognizing that even beyond that decline, that trend will be towards tighter supplies over the next few years, which will be supportive to price. So this chart looks at annual average cattle prices across all classes. So at the cutout or wholesale beef level, fed cattle, yearlings, and calves. And as you'll see the cutout forecast for next year, we have it slightly higher. No, not to the pace of inflation, but nonetheless, continuing to move higher as demand remains stout. May not look quite as good. Again, won't be outpacing inflation. Where yesterday's retail beef price that we saw was up only around 2% from year ago levels compared to inflation that's up 8.3%. But certainly not a bad thing as you think about the way we've already grown the pie in terms of beef values. Now, closer to home, looking at the cattle segments here, you'll see that the forecast has all classes of cattle gaining on that box beef value. And that's simply a function of those declining numbers as well. But in terms of the leverage dynamic, shifts prices back in favor of those cattle producing segments. We've all seen the news about the packing capacity increases that are starting to come online and slated to over the next few years. At the same time, we've regained all that capacity that we lost due to social distancing measures and COVID protocols in the plants that we were dealing with for so long. Weekday fed slaughter rates now pushing up towards the highest levels that we've seen in quite a few years. So showing that we can also get that done with the capacity that we have today. All of those in favor of cattle prices and leverage for the cattle segments. So as we look a little bit more specific towards these trends over the next few months, this slide, a few things on here, but top chart is looking at monthly placements into U.S. feed yards. And our expectation here would be that that August placements and September both on pace to be below year-ago levels. And as you look over the next few months, these tighter cattle supplies, smaller calf crops, the ones that hit the ground this spring, was the fourth year of a declining calf crop. And so those things favor that placements will be at a more moderate pace. Now, as you look back towards early in the year, we certainly know that they were propped up by drought, especially during that January, February, March, April timeframe. As you'll notice, placements that were above that 5-year average, in particular in that Feb through April time period. And you certainly had some drought force movement there in July and August as well. But recognizing that as long as drought conditions don't worsen and they appear to be getting better in most regions of the country, we should stop seeing that to such a degree as well. Now, what that means in terms of feed yard inventories, on the bottom chart, you'll see that as of September 1, we believe that on feed was basically on par with year-ago levels, but still up from the 5-year average. As we work through the fourth quarter, they will grow just simply seasonally You have all these spring-born calves that many of them heading straight into finishing yards will increase the on-feed population, but something that still remains below the last 2 years' levels and finishes the year somewhere more on par with the 5-year average. And as that happens, as we do continue to see on-feed cattle supply numbers that are below year ago, that'll be supportive to price, both on a seasonal basis and a year-over-year basis here going forward. This year, we're on pace to average a fed market somewhere around 142, and that compares to a 122 average there last year, $20 per hundred increase in the matter of just 1 year. Now, we have flattened out here over the last couple weeks, given a couple dollars back to the market. And as you look at this seasonal index, the purple line, not uncommon that here, plus or minus Labor Day, that you do see some softening to the market. As we do look here going forward, we do see where the broader trend is higher into the fourth quarter. And we expect to see a Fed market that gets up into the low to mid 150s for a high here in the fourth quarter. And then as we roll forward into the new year, again, can be a little bit more sideways of a market during that January, February time period, but then continues to move on higher into a spring high, somewhere there north of that 160 mark would be our expectation today. Yeah, even in these tighter supply years, you do tend to get a pullback during the summer months, but even so, we think that 140 mark should be very strong support and could be higher than that, just depending how demand and these leverage dynamics play out. So as we do start to break down this feeder cattle supply, so the latest estimate that we had from the USDA on July 1 suggested that the feeder cattle supply outside of feed yards, so those cattle throughout the country, was down around 1 million head compared to year-ago levels. But what that number masks is what's the breakdown, what's the composition of that decline, of that tighter feeder cattle supply? Because that includes both yearlings that are out on grass, fall-born calves, as well as that's the first take of the spring-born calf crop. And so what we did some work here doing is breaking down that supply in terms of feeder supply and the calf supply. And what it suggests to us is pretty interesting and in terms of the trend there. As you look at the feeder cattle supply in the green line, it actually shows that it is record tight, edging out the previous low in 2018. And on a year-over-year basis, down 5.8%, or north of 500,000 head from year-ago levels. Not all that surprising as we think about that there were simply less yearlings turned out to grass due to drought conditions, less of them to begin with due to a couple years of declining calf crops. And then we also saw that drought-forced early movement that suggested that as of September 1, simply less of them out there are remaining today. And at the same time, as you look at the calf crop, a lot more cyclical as you look at these trends over the past few years. And recognizing that as of September 1, those spring-born calves, most of them on a year-to-year basis have not moved yet. They remain outside of feed yards. Now, that number came in down around 2% or 400,000 head from last year. But as you compare that back to previous years, certainly smaller than the past few years, and we are seeing that in terms of calf prices today, but still quite a bit above those prior cycle lows. And so as we think bigger picture, it will take the realization of several more calf crop declines and those cow herd trends until we start seeing those tighter cattle supplies that we saw in the decade prior. So as we start looking at these trends for prices, this is looking at an average on those summer videos as we roll together Superior, Northern, and Western, and look simply at a steer calf around 550 pounds for fourth quarter delivery. Those prices, as many of you have seen, most of them up kind for kind, up $35 to $40 from year ago levels. On average, these sales up around 20% above year ago levels. So certainly, these declining calf crops, tighter cattle supplies, showing themselves in terms of these videos. And that's even despite the gains that we've seen in terms of cost of gain and feed prices and those headwinds there. So with the summer video season concluded, we start narrowing in and looking more closely at the spot cash market. And this is looking at those 550-pound steer calf prices on a market year basis. So you'll see July here on the left-hand side, on into the new year, and June on the far right-hand side. And we've seen some extremely counter-seasonal strength here in the late summer. Again, as this market has continued to start sniffing out those tighter cattle supplies ahead. That strong seasonality that your highs in the spot in the cash market for calves tends to be in that March, April time period. Well, so far this year, it was actually in August. Now, we do see where as we start getting into the fall run and start seeing more calves come to town, we will see calf prices pressured as they always are here in this late September, October, November time period. But it's still at levels, they're substantially higher than what we've seen for the past few years. And our U.S. average benchmark here, which sits around 204 as of last week, we still think that pretty strong support. They're in the 190 range. And then as we do get past that initial break, especially those early weaned calves, start getting into the longer weaned calves, start to see a firming trend as we work on in towards November and especially December, January. And as we work towards next year, you expect that market continues to move higher on into the spring. And we'd anticipate a spring high somewhere there around the 265 area. But certainly, that's a number that you can see move around quite a bit just based on how much demand for grass calves is there. And so we'll be watching weather patterns pretty closely over the next few months to determine that. So as we do start thinking about that decline to the calf market, and again, try to put some perspective around how deep can the calf market get this fall. This is one simple metric that we like to look at. So it's a percent change in that spot calf price from the first half of the year high to the second half of the year low. And it would suggest that on a long-term average basis, you tend to decline around 15%, but obviously a pretty wide range around that. This year, if you do see a decline from that 205 level of around 5%, which wouldn't be too surprising if we do think about these cyclically tighter supplies, that would suggest a calf market supported around a 195 area. This certainly could see something that gets in towards the low 190s. Wouldn't be surprising as you look at this comparison here. But what we'll need to be watching is what's the demand, especially into those winter wheat grazing areas, and how those prospects begin to look over the next few weeks and next couple months. So as we do think forward, another thing to consider as we think about the trends here and the calf market, what this illustration looks at is how much does the market tend to pay if you were to take a 550-pound steer calf in October, background them, add some weight, add some time, and sell them in February at 850 pounds. Now, obviously, there's a lot of ranges around that scenario, but this is just the one that we run for a benchmarking sake. And I would say that historically, that the market has paid around $296 per head over the last 10 years to add those 300 pounds. No, certainly that's a number that breaks down to a cost of gain of around 90 cents per break even. However, as we start looking at that for this year, and use some basis assumptions and look at where futures are at today, what the market's suggesting it would pay you. Currently, that's sitting around a 145, a 149 area for break-even cost of gain. So suggests that if you're able to add weight to calves for a cost of gain below that, the market will pay you a net profit for doing so. So something to consider as you do also think about this scenario here, this very typical shape where whatever the lows are in the calf market tend to be there, right around the 1st of October, and then moves higher from there. And you will notice that in these years where the market tends to be trending higher in total, tend to be the years that have a larger payoff. Now, obviously, again, that is pretty contingent on Troy's discussion and really what is the cost of feed and what is your cost of gain. But something to consider here. So as we do look at the yearling market, again, market that has been very seasonal, moved up towards around that 180 level for a yearling. As we look going forward in these, as we deem them non-expansion years or these liquidation environments, heading into tighter cattle supplies, you can see a lot more flat pattern through the 4th quarter than you would if you look at a 20-year average. But nonetheless, as we roll into the new year, extremely strong seasonality that your lows for the feeder market are in the 1st quarter of the year, first 3 or 4 months of the year. Predominantly, as you think about those backgrounded calves that are starting to hit the market. Now, even so, we think that roughly that 175 area should be pretty strong support as we roll through the 4th quarter. But recognizing again that especially this feed grain environment is something that could be a headwind and could make it underperform through there. But still, regardless, we think a market that's still substantially higher than what it's been the past few years. Now, as we start taking a look at cows as well, I have here a chart looking at the 90% lean beef price, where this and cow prices, cull cow prices, are so tightly correlated. So what we'll tend to see here, or what our forecast is through the end of the year, you'll see a pretty flat 90s price. And as you compare those levels in the black line to the past few years, obviously a pretty elevated level. And as we look on into next year, continuing to be pretty stout as well. So what this means in terms of cows, again, as we do start seeing more culled cows brought to town, do expect them to be pressured here through the 4th quarter, and pretty strong probability that here on the backside of Labor Day is when you start seeing pressure start to show. But nonetheless, the box I have outlined here shows where we think there remains pretty strong support for cows. They're around the 75-cent level. And again, that's a U.S. average, so adjust for your region, but still pretty substantially higher, even at its 4th quarter lows, than where it's been the past few years. In a market that then, as you move past the glut of cows, moves higher into the new year, and especially on into March. Similar to what I walked through, on the steer calf, we'll tend to see where adding some weight, avoiding that 4th quarter low for cows, rolling them into the new year, especially past that February 1 mark, does tend to have a pretty positive benefit over time. Again, with feed grain discussion, pretty critical to manage cost, but something for folks to consider. And as we do look cyclically here, and thinking bigger picture, as we do move these calf prices higher, do move cattle prices higher over the next few years, expect that we're going to see the same thing happen in terms of the bred female market. As you look at the past few years, as calf prices have been in a pretty tight range. So have bred heifers, just the one benchmark I have here on this chart. But as you do look forward and actually look back over our shoulder at the last cattle cycle, as calf prices started moving higher, bred female prices shot higher as well. And what's important to remember as we work through that last cycle is those heifers, those females that were purchased at the top, never paid themselves off. As you think about, they were purchased at the cycle highs, and we were starting to see larger calf crops, and the market then subsequently started rolling over, and they were selling calves here in the past few years. So as we look going forward, as calf prices start moving higher, female prices as well. And so the consideration here would be is if you are looking to expand the herd or even just swap out females, sooner is certainly better than later as we'd look at things to try to avoid that same scenario, of females that never pay themselves off as you look over the next few years. So with that, I'd like to pass it over to Dr. Ayers with Landco Animal Health. Should be headed your way.
Can you see it?
We've got it.
We're good?
Oh, now we're looking at your presenter view.
Oh, okay. I'll just leave it this way then, and just to make it easy then. Is that okay?
Perfect.
All righty. So thank you. We appreciate being part of these webinar series, and appreciate everybody's time here this evening. So I just wanted to kind of go through a study that we completed last year, a couple of colleagues of mine, and using Scour Boss. This time of year, we're starting to think about handling our cattle, weaning, getting cows ready for next year, and then getting these cows ready for calving this next spring. So I thought it was a timely topic. One thing we would like to, why isn't that working? There it goes. Just want to show you some historical data with using the Scour Boss vaccine and E. coli against an E. coli challenge. There were 0 losses of those calves to E. coli with 67% losses on the unvaccinated group. Mortality to rotavirus, again, was 0 for the vaccinated group, and showed about a 15-pound advantage. So the colleagues wanted to look at it, and we know that the idea is that the more antibodies that we have in colostrum, the idea is that calves will be better protected. That's the even specific antibodies, but in just general, we want high levels of antibodies passed in the colostrum for the calves to absorb to protect them as they get exposed to these things in the early parts of their life. So we wanted to look at a couple of specific titers specifically to coronavirus and rotavirus, and to see if we move those titers high compared to unvaccinated controls, and then we threw in a competitor just to kind of see how as a group how scour vaccines modify colostrum antibodies. This study was done in California at a commercial dairy that did not vaccinate their cows, so with a Scour's vaccine, so they were unvaccinated animals. We tried to use similar numbers in the group, and I'll show you that here in just a second. But there was 3 groups of these cattle, and then vaccinated control, labeled doses of ScourGuard because they had not seen a vaccine before, so the label says we needed to use 2. And then the same way with the Scour Boss group, 2 doses, one with the Scour Boss 9 and one with the Scour Boss 4, all per label. The cattle were bled every time that we handled them, and that was to assess serum antibodies. And then the day that they calved, we collected colostrum in order to look at those specific antibody levels as well. This is kind of the timeline, just so you can kind of see it linearly. And so at the beginning, at the dry off period, oral on the heifers, we just backed up from their due date, and so that everything would be on par with each other. And so each time point, you know, we drew blood that they were handled, and then again 2 weeks pre-calving in order to, or pre, you know, their due date, in order to assess the response to the booster doses on both of these. And then again, the colostrum antibodies. Here's the numbers, just so you can see that, you know, we tried to keep everything pretty even as we went. So now we'll get into kind of some of the results of the study. This is for the coronavirus, specifically for the coronavirus. So the gray bars are the unvaccinated controls, the orange are the scour guard, and the scour boss are in purple. And so you can see here at the beginning, prior to vaccination, all cattle were fairly close to the same serological titers for coronavirus, and not statistically different. At the time of the booster, we'd start to see some spread. So this would indicate that cattle did respond to those vaccines, to the first dose of the vaccine, the primer dose, and they are statistically different than the controls here. So the pre-calving dose, that gives us an idea of what the booster dose did, how the immune system responded to the booster dose. And you'll see that the controls are still pretty flat. The two vaccinated groups increased, with scour guard remaining about the same, and the scour boss actually having a much greater response to the booster dose. And then when we look at the colostrum for coronavirus, we see that, you know, controls do concentrate antibody into their colostrum, even though they've never been vaccinated. They do concentrate some antibody in there. Here's the scour guard group, and a statistically higher coronavirus titer in the colostrum with the scour boss. And this is the results for the rotavirus. Again, fairly uniform, not statistically different between the groups at the primer dose. This would be the response of the immune system to the primer dose. And while these are much lower than coronavirus, they are still both vaccinate groups are higher than controls, and there is a difference between the two brands as far as stimulation from the primer dose. We look at the results of the immune response to the booster dose, and again we see that the controls stay about the same. So there's, you know, indicating that they're pretty stable. We do see an increase in both the two brands, the scour guard and the scour boss, compared to the controls, but they are not statistically different from each other. They both went up. They are numerically different though. And then you see the colostrum, and here again, control cows do concentrate some antibodies into the colostrum, but a much greater increase in both the vaccinate groups, the scour guard and the scour boss group, with not a statistical difference between the two due to variation more than likely, but there is a numerical difference there. The take home is vaccinations, scour vaccinations do increase. At least we can show the increase in the rotavirus and the coronavirus titers. So we can certainly demonstrate that, and that there are some nuanced differences between brands. But the take home is we can increase those titers and hopefully offer those calves a greater protection during that first 30 to 45 days of life, when they're pretty vulnerable to these diseases. And with that, thank you, and happy to answer any questions if anybody has them.
All right. Thanks, Dr. Ayers. Yeah, definitely a very timely discussion there. And we appreciate your time and again, the Landco's continued sponsorship of this webinar series. And if anybody does have any more questions, please continue to throw those in the chat box. A couple other quick announcements here, a couple CattleFax events that we'd like to flag for you. We will be having our annual Outlook and Strategies meeting, a really in-depth look about what to expect in the year and years ahead here in Denver, the Tuesday after Thanksgiving. But also this year, we are adding an online option as well. If you don't want to make the full trek, there's that option available to you as well. And then, as always, we will be at the NCBA convention in New Orleans in February, giving an outlook there. So please drop by and watch the outlook and come say hi to us at the booth if you're in New Orleans at that time. So with that, we apologize that we are a little bit over time here, but we do have time for at least one question here. One that we do see, Troy, I just believe this would be one for you. The question is, where do you see first quarter soybean and DDG pricing?
That's a great question. There's a couple of things going on. We talked about soybean stocks to use getting tighter. If you're looking at March soybean futures today, if stocks to use start to get tighter or yield starts to get smaller, they have the potential to get up over that $15 area and possibly reach that $15.50 to $16. New highs are not out of the cards for soybeans, given the fundamentals that we have for them today. If stocks to use tighten just a little bit, we talked about small changes in the balance sheet having big impacts on the stocks to use. DDGs are a little bit more regional, right? If you're in the Midwest, DDG's prices will likely stay in line with the corn market expectations. But if you're in Texas or any of the Colorado, any other states that are not in the Midwest, it could get a little lofty on prices for DDGs going into that area. Corn and basis in those areas remain strong, and because of that, you might be pricing some of those ethanol producers out of the market.
All right, thanks, Troy. And with that, in the interest of keeping the time, we'll go ahead and conclude this webinar for this evening. But if you do have any other questions that you come up with afterwards, please send us an email and we'll be happy to address those. Otherwise, again, thank you for taking the last hour of your time to be with us, and hope you all have a good rest of your evening. Thanks.